The main difference between the S&P 500 and Russell 1000 lies in their composition. The Russell 1000, established in 1984, tracks the top 1,000 U.S.-based companies and is a subset of the broader Russell 3000, which accounts for 99% of the U.S. equity market. In contrast, the S&P 500, first introduced in 1923, tracks the top 500 U.S.-based company stocks, representing 80% of the U.S. equity market. As a result, the Russell 1000 tracks more shares than the S&P 500, making it more diverse. To qualify for the S&P 500, a company must have a market capitalization of $12.5 billion or more and generate profit for 4 consecutive quarters. The index has a committee of professionals that meets monthly to decide which companies will be included. In contrast, the Russell 1000 tracks the performance of the top 1,000 companies in the U.S., excluding companies with less than $30 million in market capitalization, and includes mid-cap stocks, which are riskier but promise higher returns. This means the S&P 500 has more stringent eligibility requirements. In terms of rebalancing, the S&P 500 rebalances its portfolio quarterly and reconstitutes annually, with a committee that meets monthly to approve changes. The Russell 1000, on the other hand, is reconstituted annually at the end of the second quarter, with quarterly changes that include IPO offerings and float updates. This results in the S&P 500 changing more frequently, which affects the benchmark quality of mutual funds and ETFs. Despite these differences, both indices track stocks of publicly traded companies and are considered large-cap stock indices, with market caps greater than $10 billion. They also have similar performance and volatility. Ultimately, the S&P 500 and Russell 1000 can be seen as interchangeable, given their negligible performance difference. Both indices are worth considering when choosing an index fund, with the S&P 500 offering a favorable rebalancing and update schedule.